Yield curves invert after a hot CPI. Stocks hang in there despite poor bank earnings, and energy prices rebound as the geopolitics start to escalate. All this and more in this week's Macro Insight. Welcome back to Macro Insight, everyone. Today is 19th of July, and let's have a look at these markets. So last week, really, the big thing was the dollar. The dollar continued to, grind, if you could call it grind, but charge higher, probably more more accurate a term. And then it has pulled back since then, but we did see that brief break of parity on the euro. And I had suspected that parity, at least on the first test, would try and hold. And that's certainly, what we did see. But, dollar has pulled back. It's back to kind of, sub 107 levels. Stocks finished small down on the week last week, but staged strong rally on Friday, post the, obviously the expiry in the morning in the S&P. We had better bank earning out of Citibank. And then Chinese stocks got hit last week on COVID concerns re-emerging, basically, and also GDP missing. In terms of rates, we saw yield curves bull flattening. As the hot CPI that came out, 9.1%, 1.3 month on month, pretty hot number. That kind of anchored front end rates, but the longer duration bonds caught a bid as inflation expectations rolled over. So despite current inflation printing higher than expectations, the longer run inflation expectations continue to roll over as we see more and more signs of a recession coming, basically. And that dynamic continues despite the immediate high prints that we've seen in inflation. Okay, and we've got pretty decent momentum on inflation as well still, if you look at some of the stickier stuff, which we'll go over in a minute. Commodities were weighed down by China still. Iron ore was down pretty hard. You can see that was down about 2 standard deviations. And then gold remained heavy. Copper also got down to pretty oversold levels, but did stage a bit of a bounce. Obviously, we stepped in there on our tactical long trade. That worked out pretty well, touch wood for now. And then finally, crypto starting to decorrelate from stocks late last week. And then we saw a nice continuation of that rally over the weekend and seeing some relative strength in crypto, which we haven't seen for a long time. So that's generally kind of what we're seeing in terms of main market moves. If we then have a look at, the inflation in a bit more detail. So obviously, beat expectations. As we've been flagging, the stickier components showing no real signs of slowing, which will likely keep pressure on the Fed. However, Bullard and Waller were both pretty quick to talk down the 100 bip hike that the market started to price in, right? So the market kind of went to 50-50 for the 75 or 100 bip hike for July, and they kind of talked that back down as that speculation was kind of coming in. And now they're in blackout period, right, until the meeting next week. So, we'll see if anything needs to get leaked, but we're probably not going to get any data points that are going to make them panic. We did also see long-term inflation expectations from University of Michigan come softer, and that had been the number that had spooked them the last time round and made them leak that extra 25 bip hike. So the fact that number's coming down, that kind of helped spark a recovery in stocks last week and probably takes the pressure off them to do 100 bips in July, even though some people are still calling for it and there is still some probability of that priced in. Okay. In terms of bond markets, they initially sold off, but then they recovered as those yield curves flattened, like I say, signaling that the Fed pivot next year was looking inevitable. And we did see an inversion in the 2s10s to like cycle lows of like negative 20 basis points. Earnings has been the big thing as well last week. Obviously, bank earnings kicked off the season. You had JPM and Morgan Stanley both missing EPS expectations, and that did take the market a bit softer. The sort of largest culprit really for these bank earnings being so much lower is really investment banking revenues, right? They seem to be dropping by 50% or more across the board. Bank of America and Goldman's also showed lower earnings yesterday. Goldman's, as always, managed to beat expectations, though. They always pull a rabbit out of the hat, and they usually have higher trading performance, right? So they're obviously still one of the banks that likes to take a bit more proprietary risk. And so often when we get volatility in markets, whether it's equities or fixed income or whatever, they tend to end up doing all right, and they make a bit of money off that. So it did still beat, even though their earnings were down year on year, they did beat expectations, right? And they ended up about 2.5% in the stock yesterday. Now, the big surprise in banks has been Citibank. They surged 13% on Friday in terms of the stock price, lifting sentiment across the whole sector, right? So you can see here, you had your JP and Morgan Stanley miss on the Wednesday, and then on the Friday, this massive upward move came from the Citi beat, blowout quarter for their trading division, basically, right? And trust me, I used to work for Citibank. It's not often you see Citi leading the way in terms of banks and bank earnings. Normally, the likes of JP, Goldman's are way ahead, but this time Citi surprising to the upside, which is interesting to see. Now, increases in net interest income, loan growth were cited as positive trends for the sector, and this has also helped Wells Fargo recover from what were poor results. The market was able to look through that. So you can see all of these banks kind of on the week are actually up, except for JP Morgan, despite them all kind of missing numbers, right, for the most part. Yeah. Now, the sector is still down around 20% so far this year. And both Citi and JP have suspended their share buyback programs due to higher capital requirements after the Fed stress tests showed that they needed more capital, basically, right, amidst a looming recession. Okay, so that is one negative for the sector, that these guys are going to be doing less buybacks. Yeah. Okay, so that's the bank earnings. If we then look to sort of this week, the real big story this week is going to be Europe. All right, so this Thursday we've got ECB expected to start their hiking. 25 basis point hike is obviously nailed on, but there is a small chance of a 50 bip hike, which is being talked up a little bit today, which is why we've seen a bit of a pop in the euro. And you can see in the top left chart, I mean, we're still sitting there on the black line in the policy rate, and inflation's up there on the moon, basically, right? So, I mean, it is ridiculous how long they've taken to get out of the gates. And so they've got a lot of work to do to get anywhere near inflation, okay? As their policy rates are still negative, for crying out loud, right? Which is just ridiculous, right? Now, the Eurozone economy is facing multiple risks, however, right? From the ongoing energy crisis, which could get worse this week if the Nord Stream 1 pipeline is not switched back on. Okay, and it does seem they shut down for maintenance a week ago, and people had feared that they weren't going to come back online. And now Gazprom has come out and declared force majeure on gas supplies to Germany, which is not a good sign, right? So all things are starting to point to the idea that that's not coming back on. And it seems like Europe is kind of aware of it. I wouldn't say necessarily prepared for it. There's not really a lot they can do, but they're starting to ration energy usage and stuff like that, right? So definitely something that's going to hit the headlines on Thursday, likely on the same day as ECB, and could certainly create a little bit of panicking going on, right? But it is a news story that's been around for a few weeks at least. So I'm not really sure how large the reaction is going to be, but given what some people have been saying, like UBS put out a research report saying this was going to be disastrous for the European economy if that gas didn't get turned back on. So you are likely to see some spooky headlines coming out on that. Yeah. Another concern: Italian politics, right? So Draghi obviously trying to resign, and he's basically got to get back in front of Parliament on Wednesday with his plan or whatever. BTP Bund spreads aren't liking what's going on in Italy. They've blown back out to around 220. And so that's really not what the ECB wants to see as they're about to embark on a rate hiking cycle, right? Anti-fragmentation tool is going to be scrutinized on Thursday, but the chances are it's going to be a major disappointment, right? They're going to talk about various austerity measures that need to be implemented if you want to, get the backstop of the anti-fragmentation tool. I mean, it's likely to be a bit of a disappointment, it seems, right? So given this spike we're seeing in euro, that might not be a bad sort of thing to fade. There might be some more upside still back to like 103, 104, but I'm starting to think fading that isn't a bad idea. And then, like I said, euro dollar did hold. You can see the chart on euro dollar. It kind of held parity. I mean, the wick went down below parity, but it kind of finished back above on the first test. But I fear that on the next break of parity, I don't think it'll be so kind. We might get a real like shank down to 95 or even lower, right? So watch out for that, I would say. I don't typically tend to care that much for the VIX expiry and think it's that much of a major impact on markets. But given that the OPEX is already out the way, and if we look at kind of how VIX has been sort of behaving, and the fact that VVIX has been kind of under pressure for a while, that's what makes me believe that, yes, there may be some impact for VIX expiry. And, you know, I had talked last week about the idea that, you know, VVIX had been staying under pressure because dealers keep getting sold puts, basically, right? So whereas I used to think, you know, obviously the demand for calls is still there from people who are hedging, okay? But there used to be a demand for puts to play downside in the VIX, to play the roll down and all those type of things. And because of that, as we get into a VIX expiry, if the VIX is under pressure and you're going towards that concentration where you can see here in the bottom chart, you've got quite a lot of put open interest sort of from 25 down to 20, right? So if the dealers have been getting given those puts, right, then that is going to potentially lead to a bit of that stickiness that we see when S&P pins near a strike. You may get the VIX kind of being stuck in that zone, right? And also if there is like time, because there's time decay on these things, right? So if as those VIX puts that dealers are long, as those puts decay away, what's going to happen? Well, they're going to be long VIX futures against them, and they're going to be getting rid of those VIX futures, right? Which is essentially charm, right? Just like you have charm buying of S&P futures, you have charm flows in VIX. If this is the setup that they're short those puts, they're long those puts and short the calls, then you're going to have VIX futures selling into that expiry through the time decay of all those options, basically. Okay, so that may be why we could have a bit of a lid on the VIX until after that auction on Wednesday morning, and then things free up a bit. Things can free up a bit to move, basically, right? So if we do get an overshoot on the VIX to the downside from that charm selling, and we get into this sort of support zone that I've put here of 22 to 24 on the VIX, I think that's quite a nice area to own some VIX into next week, as we've obviously got mega cap tech earnings next week. We've got FOMC next week. So I don't think the VIX is just going to completely fall out of bed ahead of those things, right? So a bit of a bounce in the market and sell off in VIX over the next 24 hours into tomorrow's opening auction probably provides an opportunity to buy VIX or sell the S&P, whichever way inclined you might be. It's kind of the same trade right now. That would be my thoughts there, right? Obviously, no love from Saudi, right? Biden went, you know, it was most people kind of in the know in oil was saying that he wasn't going to get anything out of Saudi, basically, right? So whilst oil kind of had its sell-off, it's kind of bounced pretty strongly, right? Back towards 100 on WTI as he came back kind of empty-handed. They're not really, doesn't sound like they're going to have much production to raise in terms of capacity, or they're certainly not going to commit to much. There is an OPEC meeting in early August where we'll find out more, but there doesn't seem to be any real firm commitment out of the Saudis. The tightness in the market seems to be persisting. So the time spreads are still pretty elevated, above $2, $2 to $3 in the front month time spreads in oil. That is going to be supportive. That is also going to encourage people to kind of invest in the space because they've got a carry yield that they can earn as they roll their longs, basically. So that's something Tony Greer's been talking about, that, you know, you get to be long this thing, the trend looks amazing, the geopolitics and the macro are there, and you're getting paid, you know, $3 a carry a month, right? Not the worst, 3% basically, right? Because we're on a base of about 100. The 3% carry a month for something that looks like a fundamentally good position seems all right. But anyway, nat gas prices obviously were the big one, spiking massively, even in the US, as this kind of nervousness around Nord Stream is growing. We may see oil get dragged up as well due to substitution effects. People switch from gas to oil, which they can do in certain sort of industries and things like that. Recession risk and demand destruction, which have been in the headlines last week, seem to have taken a back seat over the weekend. You know, the volatility and the political chess playing continues. Futures open interest has kind of plummeted, as Eric Townsend has been mentioning in Macro Voices. So that suggests that specs are kind of just getting out of the oil game a little bit. BoA Flows also saw huge energy and material outflows in terms of their weekly flows, in terms of stocks and things like that. So that suggests more de-risking in the space, basically, right? So there's been a fair amount of de-risking in commodities overall. We're obviously seeing weakness across the complex. Metals got trashed. Now energy also got hit, but energy's starting to rebound pretty fast, right? And it seems that it's not going to take much for energy to just fly back to the highs, basically, because there seems to be a bit of geopolitical escalation going on, particularly with this Nord Stream news. And that may be the catalyst to take energy higher again, basically, right? So something to be aware of. Thanks for watching, guys. If you like this content, please subscribe to our channel, give the video a thumbs up, and hit the notification bell so you don't miss out on future videos. To watch the entire macro call, which includes the live Q&A and a walkthrough of all my top trades, you can sign up for a free trial to Macro Insight. If you join our exclusive trading community, you'll get access to our Telegram group, and you'll also get weekly market reports summarizing the macro call. The link is in the description to the video. And for more information, you can connect with us on socials, or you can visit our website, options-insight.com. Thanks a lot.